Welcome to Countouts. In this lesson, we're going to be looking at adjusting entries. So we're going to be looking at the pre-adjustment trial balance together with the additional information that will be given and do the adjusting journal entries. These are journal entries usually made at the end of an accounting period to allocate income and expenses to the period in which they occurred. So this is the allocation of income and expenses in the period in which they occurred. And we are also looking at accruals. So let's get into this example in how to do the adjusting journal entries. Here's the example we are given. We are given the pre-adjustment trial balance on the left, which has the balance sheet accounts section and the nominal accounts section. And then we have adjustments and additional information on the right. And we are going to go through each one of them in doing the adjusting journal entries. Now, we've done other lessons as well on journals, on accruals, as well as the accounting equation, which are very helpful in thoroughly understanding adjusting entries. But we'll go through each one in explaining how it works. You'll also find the links to those lessons in the description below. So let's look at the first one. We are told that according to a physical stock taking, the following stocks were on hand on 28 February 2016. Now, usually when you're given the pre-adjustment trial balance and adjustments and additional information, you will be required to do the financial statements, either the statement of comprehensive income, the statement of financial position, and the statement of changes in equity, or a combination of any of them, or you may be asked to do one of them, and you'll be using this information here. So as we go through the adjusting journal entries, it will also be helpful in identifying what accounts are involved. Now, the first one says, according to a physical stock taking, the following stocks were on hand on 28 February 2016. We've got merchandise, 69,000 Rand, and you've got consumable stores, 200 Rand. Now, when you're given information such as this one here, you look back at your pre-adjustment trial balance. Now, you'll also have your trading inventory amount, 70,220 Rand, on the debit side of the pre-adjustment trial balance. And this is the value of inventory according to our book. So what this is telling you is that, as you can see here, it's written pre-adjustment trial balance on 28 February 2016. It means as at this specific date, this was the balance of our inventory according to our book, 70,220. But when they went and physically counted the inventory, they found it to be only worth 69,000 Rand. So if there's a disparity between what you have in your pre-adjustment trial balance and what you have according to the physical stock taking, then you will have what is called either the trading stock or trading inventory deficit or a trading inventory surplus. Now, you have a trading inventory deficit when the inventory according to the physical stock taking is less than the inventory as per your pre-adjustment trial balance. I hope it's making sense. Trading inventory deficit is an expense, meaning that our inventory is less than we have accounted for in our books. So if the one in the pre-adjustment trial balance is bigger than the one that has been given according to the physical stock taking, then you have a trading inventory deficit. And that is the case in our example here. As you can see, trading inventory is 70,220 Rand. But the one according to the physical stock taking, the merchandise, and by the way, merchandise and trading inventory is the same thing, we have 69,000 Rand. So you can see the one on the physical stock taking is less. So that means we have a trading inventory deficit. Now, whenever you have an expense, you debit the expense. So what is the journal entry going to look like for this one here? Well, we're going to debit trading stock or trading inventory deficit because it's an expense, because our inventory is less than we accounted for in our books, and we're going to credit trading inventory. Why are we crediting trading inventory? Because trading inventory is an asset and it decreases on the credit side. Now, we've also done another lesson where we show you a tip to remember your debits and credits, and you won't forget what to debit and what to credit. You'll find that lesson in the link in the description below. So here's how our journal entry is going to look. The trading inventory deficit is going to be the 70,220 Rand according to the pre-adjustment trial balance, and you deduct the 69,000 Rand according to the physical stock taking, and it gives you 1,220 Rand. That is the trading inventory deficit. Now, when we do our journal entry for this one here, you're going to debit trading inventory deficit, as I mentioned, because it's an expense, and you're going to credit trading inventory. And the narration here is loss incurred through shortage in stock on hand. Now, the narration can be different from one person to another as long as you're explaining what your journal entry is all about. Now, what if the one on the pre-adjustment trial balance was less than the one according to the physical stock taking, well, then you would have a trading inventory surplus, which is an income. So you would debit trading inventory and credit trading inventory surplus. I hope this one has made sense and you know how to account for it. Now let's go back and do the second one. We have consumable stores, 200 Rand. Now, if you go to the nominal account section, you will see we have consumable stores here as well, 1,600 Rand. What does that mean? Well, consumable stores, whenever you buy them, you account for them as an expense. All right. So we've accounted for consumable stores at 1,600 Rand as an expense. But when you're given the adjustments and additional information, according to the physical stock taking, we still have consumable stores worth 200 Rand. That means this 200 Rand is no longer an expense because we have not used it yet. So if we still have consumable stores at the end of the financial period, we are going to put it as an asset, whatever is left. So we're going to put consumable stores on hand as an asset, 200 Rand, and we put it on the debit side because assets increase on the debit side, and we're going to credit consumable stores. Why are we crediting consumable stores? Well, because we have to reverse the 200 Rand because we had accounted for it as an expense, but now that it's remaining, we have to credit that expense, meaning we're reducing the consumable stores expense. So here is how it will look. Consumable stores on hand is an asset. So whenever you add the word on hand, it means what's remaining, so that makes it an asset, and then you credit consumable stores, which is an expense, 200 Rand. By crediting it, like I said, you are deducting the expense. That means obviously if you're doing your income statement, the consumable stores expense will be the 1,600 you're given the pre-adjustment trial balance minus this 200 Rand, and the narration there is consumable inventory at end of year. All right, let's go back and do number 2. We've just completed number 1. Rates and taxes included a payment of 4,080 Rand for the period 1 January 2016 to 30 June 2016. Now, here is an expense, rates and taxes, and as you can see here, rates and taxes, we have 16,400 Rand as the rates and taxes, but we are told here that it includes 4,080 Rand for the period of 1 January 2016 to 30 June 2016. Now, if this is included in the rates and taxes, we have to ask ourselves how much of these rates and taxes belong to our financial period and how much belongs outside our financial period. So what we have to do is to take out the one that belongs outside our financial period. So let's calculate this one here. From 1 January 2016 to 30 June 2016, how many months are those? Well, those are 6 months because you've got January, February, March, April, May, and June. Now we're also including June because it's 30 June until the end of June. Now that we know that it's for 6 months, we have to remove the one that belongs outside our financial period. Now, as you can see, we're given the date here, the pre-adjustment trial balance on 28 February 2016. That is the end of the financial period. So anything that falls outside of the financial period that began on the 1st of March 2015 to the 28th of February 2016, we have to remove it. It's neither an income nor an expense because it has not been earned or incurred as yet. So let's do that. We're going to take the 4,080 Rand times 4 divided by 6 and gives us 2,720. How did I get 4 divided by 6? Well, I know it's for 6 months, this 4,080 Rand, but I know that 4 months belongs outside my financial period. Why is that? Because our financial period ends on the 28th of February. So all the months after 28th of February is outside our financial period. So March, April, May, and June, those are 4 months. So 4 out of the 6 months, the rates and taxes are outside our financial period. So this 2,720 Rand is what we call prepaid expense, meaning we have paid for rates and taxes for 4 extra months, which are outside our financial period in advance. So we have paid for it in advance. That means we have to remove it from the rates and taxes that we have here of 16,400. But the way we do it in the adjusting journal entry is to debit prepaid expense, because prepaid expense is an asset. We have not incurred that expense yet. And then we're going to credit rates and taxes because we have not incurred the expense yet. So this is how it looks. Debit prepaid expense and credit rates and taxes, 2,720 Rand. And the narration here is rates and taxes paid in advance. Now, if you'd like to understand more on prepaid expenses, we have done a lesson specifically on that one. You'll find it as well in the link in the description below. Now let's go back and do number 3. Depreciation is provided annually on equipment at 10% per annum using the diminishing balance method. And then we're also told that equipment costing 30,000 Rand was purchased on credit on the 1st of February 2016. The purchase has not been recorded. So firstly, let's take into account this equipment that was purchased and was not recorded yet. So you can see we bought equipment costing 30,000 Rand and it was purchased on the 1st of February 2016. So it was purchased during our financial period. So we have to record it. We're going to debit equipment because equipment is coming to our premises. Equipment is an asset, increases on the debit side, and we're going to credit accounts payable because we bought it on credit, we didn't buy it on cash. So here it's going to be debiting equipment 30,000 Rand, crediting accounts payable 30,000 Rand, and we put the narration there as purchase of equipment. Now we go back and do the calculation of the depreciation. Firstly, let's calculate the depreciation for the equipment that we already had, and then we'll also calculate the depreciation for the new equipment that we purchased. So it's going to be the 90,000 Rand that we are given in the pre-adjustment trial balance minus the accumulated depreciation on equipment of 22,000 Rand, and then we're going to multiply that by 10% and it gives us 6,800 Rand. So this is the depreciation for all the equipment that we have except for the new equipment. Now let's calculate the depreciation for the new equipment. Since we bought it during this financial period, it does not have accumulated depreciation yet. So we're going to take the 30,000 Rand times 10% and then we multiply by the number of months we've had it since we bought it. We bought it on the 1st of January 2016 and our year end is 28th of February 2016. So we've only had it for 1 month in this financial period. So we multiply it by 1 divided by 12 and it gives us 250 Rand. I hope that has made sense. Remember that we're using the diminishing balance method. Now if we add the two depreciations together, it will give us a total depreciation for equipment of 7,050 Rand. So what are we going to do in our adjusting journal entry? We're going to debit depreciation because depreciation is an expense and credit accumulated depreciation on equipment, and that's how it's going to look. Debit depreciation, credit accumulated depreciation on equipment. You have to specify that it's for equipment because depreciation can be for a vehicle, can be for equipment, can be for machinery. So you have to specify, and the narration there is depreciation on equipment for the year. So you can just put that as well. Now let's go back and do the next one. We are told that the rent for February 2016 is still outstanding. That's number 4. So if rent is still outstanding, that means we have not paid for the full financial period. That means we have to calculate how much it is that is still outstanding. So if you can see here in our nominal account section, we have rent income, as you can see here, 52,800 Rand. That means we have received rentals for 11 months. So that means this 52,800 Rand is for 11 months. Now for us to get for the 12th month, or to get the amount for the 12th month, or for February 2016, we take the 52,800 Rand divided by 11 months, because if you have not received for February 2016, it means we have received for the other 11 months, and it gives us an amount of 4,800 Rand. So what are we going to do with this one? Since we have not received it yet, and we know it's rent income because that's the only rental we have in our pre-adjustment trial balance, or they would have specified if it's rental income or rental expense. So it's 4,800 Rand. That is what is called an accrued income. That means income that we have not yet received, although we have earned it. So we're going to debit accrued income because that's an asset, and then we're going to credit rent income because rent income is an income and it increases on the credit side. So here is how it's going to look. Accrued income is debited 4,800 Rand and rent income is credited 4,800 Rand, and the narration is rent income for February not received. Now we've done a lesson specifically on accrued income as well, so if you'd like to check out other examples on that one, you'll find it in the link in the description below. So let's go back and do number 5. We are told here a portion of interest on loan has been paid in advance. The unsecured loan was obtained on the 28th of February 2015. Equal annual repayments of 10,000 Rand will commence on the 1st of March 2016. What are they telling us here? They're telling us that we've actually paid for some interest on loan in advance. That means we have to calculate how much it is that we have paid in advance. So let's see here, and it's important that they give us these dates to say that the unsecured loan was obtained on the 28th of February 2015. That means we've had this loan for the full 12 months, because we're told that equal annual repayments of 10,000 Rand will commence on the 1st of March 2016, which is after our financial period. So that means that the full loan that we took out, we still have the full liability in our books. We have not paid for anything yet, and we've had it for the full year. That means we know that the interest on loan for the full year is the loan itself times the percentage of the loan. So if we go back here, you can see the balance sheet section, loan Zen Bank 16% per annum, and it's 40,000 Rand. So if we take the 40,000 Rand times 16%, we will know how much it's supposed to be for the full year. So for the full year, it's supposed to be 6,400 Rand. That is how much it's supposed to be. Okay, I hope you're following along. You take the 40,000 Rand times the 16%, because we know we've had the loan for the full year because we're given the dates here, and it gives us 6,400 Rand. Now, if you go to the nominal account section, if you look for interest here, you will see that we have interest on loan 7,500 Rand. Now, remember, we're told the portion of the interest on loan has been paid in advance. That means the difference between the 7,500 Rand and the 6,400 is what we have paid in advance. And it's going to be 1,100, because the 7,500 that we have in our pre-adjustment trial balance minus what we actually owed, 6,400. It means we have paid 1,100 Rand in advance. So if you've paid for an expense in advance, that's what is called prepaid expense. And we've done this one before. So whenever you have prepaid expense, you debit it and then you credit the actual expense to reverse it, because this 1,100, we have not incurred it yet. So it's not an expense for us yet. So we debit prepaid expense and we credit interest on loan 1,100 Rand. And we put the narration here, interest on loan paid in advance. All right, I hope that has made sense. So we'll go back here and we'll look at the next one. Number 6, we are told that on the 28th of February 2016, a check of 500 Rand was received from O. Henry, whose account was previously written off as irrecoverable. No entry has been made for this. So if we have recovered a debt which was previously written off as irrecoverable, we are going to debit bank because we are receiving the money, and we are going to credit what is called bad debt recovered, which is an income account. And remember, we put income on the credit side when it's increasing. So we debit bank because money came into our account, and we credit bad debt recovered. And here's how it will look. Bank 500 Rand, bad debts recovered 500 Rand. And the narration there is bad debts recovered. So that was an easy one to do. Let's go back and do the next one. Number 7, a debtor A. Donald, who owed 800 Rand, is declared insolvent. His estate paid Kiara Traders a first and final dividend of 60 cents in the Rand. This has been recorded. The balance of his account must now be written off. So a situation like this is usually common, or a scenario like this is common, where they say that a debtor is now declared insolvent, but his estate paid a first and final dividend of 60 cents in the Rand. This has been recorded. Now, the part where he had paid the money to the company has been recorded, as we are told, so we're not going to do anything about that. But we're told that the balance of his account must now be written off. So how do we write it off? Well, this is what it's called bad debts, because he's not able to pay us the balance. And how do we know how much the balance is? Well, it's easy. When you're told that his estate paid 60 cents in the Rand, that means the remaining 40 cents in the Rand was not paid. So 60 cents is like 60%. That means the 40% was not paid to us. So for us to get the bad debt that he was not able to pay, we take the 800 Rand times 40 cents or 40%, and it gives us 320 Rand. Now that we have our bad debts, we're going to do our journal entry. We debit bad debts because bad debts is an expense, increases on the debit side, and we credit debtors control because our debtors control is decreasing, or the amount of people who owe us is decreasing by 320 because he could not pay us this amount. So that is how it looks. Number 9, bad debts 320, debtors control 320. Now after debtors control, or just in front of it, you could put the name of the debtor who couldn't pay you, or you just put debtors control as we have done. And the narration there is bad debts incurred. Okay, now we can go back and do the next one. Number 8 says that the provision for bad debts must be adjusted to 5% of trade debtors. Now, if we are adjusting a provision here, you will get what is called provision for bad debts adjustment. that can either be an income or an expense, depending on whether the provision for bad debts is increasing from the previous year or it's decreasing from the previous year. Now, if it's increasing from the previous year, that means we're expecting more people not to pay us this year. That means the provision for bad debt adjustment is going to be an expense. But if it's decreasing from the previous year, that is a good thing. We're expecting less people than the previous year to default on the payment, so we're going to put the provision for bad debt adjustment as an income. So let's see if it's increasing or decreasing. We already have a provision for bad debts. When you're told to adjust, that means you already have a provision for bad debts in your pre-adjustment trial balance. And as you can see here under the balance sheet section, we have provision for bad debts, and the amount there is 1,900 rand. Now, the provision for bad debts must be adjusted to 5% of trade debtors. Now, we have debtors control here, and the amount is 34,420 rand. But we know that we incurred a bad debt that we had just calculated from the previous scenario number 7, where we had a bad debt of 320 rand. So firstly, we take the 34,420 rand minus the 320 rand, and then we multiply the answer by 5%, and we see how much the new provision for bad debt is. It's 1,705 rand. Now, has our provision for bad debt increased or decreased? Well, as we can see, the previous one was 1,900 and the new one is 1,705. That means that's decreased. That means we have a provision for bad debt adjustment, which is an income. So what is that adjustment? Well, we're going to take the 1,900 that we had previously minus the new one of 1,705, and it gives us an amount of 195 rand. This is the adjustment. So we're only taking the difference between the new one and the old one, which is 195 rand. So we're going to debit provision for bad debt because it's a negative asset account, and we're reducing it, and it reduces on the debit side. And then we credit provision for bad debt adjustment because it's an income account, because it's decreasing. I hope that has made sense. If it was increasing, you just switch these two accounts. You debit provision for bad debt adjustment as an expense and credit provision for bad debts as a negative asset account, which is increasing, because a negative asset account increases on the credit side. If you'd like to check out more on the provision for bad debt, we've done a lesson on that as well. You'll find it in the link in the description below. And the narration here is decrease in provision for bad debts. Now, let's go back as we have just completed that one. Let's do number 9. Number 9 says that the fixed deposit at BAN Bank was made on 1 March 2015 and matures on 30 June 2016. Provide for the outstanding interest on fixed deposit. Now, this is similar to the one we did on the interest on loan, but this one here, it's an income because we put money into a bank as a fixed deposit and we are expecting to earn interest on it. So the interest on fixed deposit so far in the pre-adjustment trial balance is 3,200 rand, and we know how much we should be earning each year on the interest on fixed deposit. As you can see here under the balance sheet section, you have fixed deposit, BAN Bank, 12% per annum, and the amount there is 40,000 rand. So we take 40,000 rand times 12% to see how much we should be earning each year, and it gives us an answer of 4,800 rand. And what do we see that we have recorded so far? We've recorded 3,200 rand, and that's why we are told that we need to provide for outstanding interest on fixed deposit. So we're just going to take the 4,800 minus the one we've accounted for, which is 3,200, and we have an accrued income of 1,600. Why is it an accrued income? Well, because it's income that we have earned and we have not yet received it or accounted for it. So let's go to a journal entry. You debit accrued income because accrued income is an asset, and then we credit interest on fixed deposit because that's an income, and the amount there is 1,600, and the narration is outstanding interest on fixed deposit. Right, let's go back and do the next one. Number 10 says that service fees according to the bank statement for February 2016 have not yet been recorded. Now here we incurred a service fee of 160 rand, which we have not yet recorded. And we know that service fees form part of our bank charges. So we're going to debit bank charges because bank charges is the expense, and we're going to credit bank because the money came out of our bank account as per the bank statement that we are told, and the amount is 160. So we debit bank charges 160 rand and credit bank 160 rand. Now they used the word service charges. They could have used bank charges, and you'd still do the same thing that we have just done. And the narration there is bank charge for February. Then we can go back and do the last one. Number 11 says the telephone account for February 2016 has not yet been paid, 320 Rand. That's another easy one. If you have not paid the telephone account and you have incurred that expense, that is what is called accrued expense. Accrued expense is a liability, so that means we put it on the credit side because the liabilities increase on the credit side. But what do we put on the debit side? We put telephone, because telephone is an expense account since we have incurred it. So we go there and debit telephone 320 Rand, credit accrued expense 320 Rand, and the narration there is telephone expense incurred for February. And we have just completed all the adjusting journal entries that we needed to do according to the adjustments and additional information we were given. I hope it has made sense. I hope you've gained value from this lesson. And if you have, consider subscribing to our channel, like this video, share it to those you think it might help. We also provide one-on-one lessons at reasonable rates, and you can find more information at our website countats.com, as well as other services that we offer. And you'll also find our email address where you can contact us in the description below. Till next time, cheers.